The Federal Open Market Committee, also known as the FOMC, is the policy-making arm of the Federal Reserve, which is the central bank in the US. The FOMC is responsible for setting monetary policy in the US, so that includes any changes to the discount rate or the federal funds rate. So the federal funds rate is the target interest rate set by the FOMC. This is the rate that depository institutions like banks use to borrow or lend money to each other overnight at the Federal Reserve. The FOMC doesn't actually define the exact rate that these institutions have to use. Instead, they set the target rate that guides the process, but the actual rate is decided through negotiations between the institutions involved. And the average of all the rates from all the transactions is then referred to as the effective federal funds rate. Then the discount rate is the interest rate for any short-term borrowing by banks or other institutions directly from the regional Federal Reserves. It's usually higher than the Fed funds rate because they want to encourage institutions to borrow from each other rather than from the Fed. So borrowing from the Fed is usually the last resort liquidity for banks. But it means lending between banks doesn't end up going too far beyond the target Fed funds rate because there's an alternative. So these rates that are set by the FOMC influence short and long-term interest rates throughout the economy, among other things. So the FOMC plays a significant role not only in the US economy, but in the global economy as well. The decisions they make will affect economic growth, employment, inflation, as well as having an impact on the markets. So the FOMC was established in 1933 as part of the Banking Act, and it gave it the power to set the nation's monetary policy. It's made up of 12 members. This includes 7 members of the Board of Governors and 5 of the 12 Reserve Bank presidents. The president of the Federal Reserve Bank of New York is a permanent voting member, and then the other 4 are rotated on an annual basis. The committee meets 8 times a year to assess economic and financial conditions, primarily in the US but also globally, and they make decisions regarding the monetary policy. Now, the FOMC has a mandate that's been set by the US government, often referred to as its dual mandate. It states that the Fed's goals should be maximum employment, stable prices, and moderate long-term interest rates. They have a few tools that they can use to achieve this mandate, but by far the most important are interest rates. Adjusting these will directly affect everything and everyone in the economy. It affects borrowing costs, the amount of interest earned on savings accounts, the labour market and wages, among many other things. And as a result, each of these aspects also has many other knock-on effects as well, so it's very widespread. So these 12 policymakers at the FOMC have a huge amount of power and influence. Their decisions ultimately affect the decisions made by US citizens and businesses, and those around the world. For example, if they raise interest rates, that can make borrowing more expensive and create a drag on economic growth because businesses are going to be expanding slower, consumers have less money to spend. This in turn affects the labour market and can slow down wage growth. That might further impact how consumers are spending their money because their jobs might not be as stable as before. They might be earning less money or have reduced future prospects for higher wages. And if consumers and businesses are spending less and less, it's going to impact economic growth, and that may actually lead to a recession. And obviously the opposite can be true when lowering rates, which could stimulate economic growth and have the opposite effects on all those things that I mentioned. Now, if there's a problem in the economy, the FOMC may also take emergency measures to try and solve the problem, like we saw happening during the pandemic when they announced unlimited asset purchases. However, when these sorts of actions are taken, there's always a risk involved as well. When you aim to increase the money supply, then it can stimulate demand, but also lead to rising inflation. And as I mentioned before, inflation is one of their primary concerns. Although they want stable economic growth, their primary focus is on achieving their 2% inflation target. If it's below that target, they'll take measures to increase inflation, and if it's above it, they'll take opposite measures to reduce inflation. Now, for us in the markets, this means that the FOMC can cause a lot of disruption to prices. There are a few key things that we need to pay attention to. The most important and most impactful in the markets is their monetary policy announcement following the FOMC meeting. Then we have the FOMC meeting minutes that are released sometime after that meeting, which gives us more of an insight into what was discussed and what may be coming up in the future. And we also need to pay attention to any speeches or comments in the press from FOMC members, particularly the voting members, as this gives us a gauge of what direction they may be going in next. Now, the FOMC pays close attention to the same economic data that we see released in the monthly cycle, and this data will influence their decisions. So if you want to know more about each economic data release, Check out the playlist that's on screen now.